In the first days of the Clinton administration, we were in a period of growth and boom in the world. There was a real sense that the opportunities for the United States to take advantage and to lead in this period of globalization were enormous.
Countries would be pushed to free up trade, sell off state-owned enterprises, and open their financial markets to foreign capital. It was called the Washington Consensus. It was, in fact, Washington's prescription for the world.
We saw it in our interest, as it was, to liberalize markets, to get these countries to plug in better, to get capital to flow in. It's in the interest of these markets for capital to flow in. And to make that a condition for entry into these clubs that these countries wanted to join is a sensible, responsible thing.
The constituency for pushing hard was very strong. It's all of corporate America. I never ran into a company that said, you know, you're going too fast.
Voices urging caution were drowned out. Developing countries became emerging markets, and removing barriers to the free flow of capital became the price of admission into the global trading system, the club of industrialized nations.
So here's Los Angeles.
The principal actors became American companies.
Very nice to see you.
And the Wall Street firms. One, they had more knowledge than anyone else. They were out there. And secondly, they became the, in a sense, the surrogates for American influence and power. So we were heavily influenced by their views.
And I think that there was also a degree of hyping that I and others were guilty of, where we would say, here are these emerging markets, let's go in and let's take advantage of them. And what we were saying was, look, we have common interests with these people, common commercial and economic interests, as well as common social interests. And let's try to define the relationships in terms of those common interests. That was the right thing to do.
The emerging markets would be opened up to the full blast of global competition. And millions of Americans became unknowing investors in a laboratory experiment in globalization.
Tiene que ser time.
Emerging market is just Wall Street buzz talk. That's all it is.
Washington-based journalist and author William Greider has spent 20 years studying the impact of economics on society. In his 1997 book, One World, Ready or Not, he warned that U.S. insistence on the unfettered flow of capital would prove to be dangerous.
The U.S. government, in numerous situations, played hardball and said, hey, if you want to stay in the club, you better liberalize your banking system along the terms that we say. You better remove your capital controls so that we can go in and out on our terms, not your terms. Basically, you've got to give up your sovereign governing powers to this global system and trust the global system to lift you out of poverty.
In the early 1990s, the first hot new emerging market would be the country closest to home, Mexico.
The Americans wanted all of Latin America to totally open up their borders to trade with the United States. And we're presenting this in terms of it's in your best interest to do this. You should open up your borders because trade liberalization is good for you. It's the right thing to do. Not because I want you to do it, but because it's the right thing to do.
Jorge Castañeda is a professor of political science at the National University of Mexico. His book, The Mexican Shock, probes the economic relationship between the U.S. and Mexico.
The Latin Americans were being told this is the tide of history. You have to go along with it.
Mexico embraced Washington's consensus. It tore down trade barriers and opened up its financial markets. Foreign investment in its stock market climbed more than 400%, and Mexico boomed.
The real fuel for that boom was a very simple reality in global finance. We had at that moment, in the early 90s, relatively low interest rates in the United States because the Fed was still trying to help some banks get out of their troubles, our banks, and also get the economy going again. So if you borrowed money in New York at 3% and took it to Mexico and invested it in stocks or bonds or even directly in companies, you could expect a return of at least 8, 10%, and maybe 20 or 30% if you hit the right bells. So, of course, people did that. When did the boom begin to break up? In 1994, when the Federal Reserve started raising U.S. interest rates. And as the 3% rate became 4%, then 5%, then higher, that profitable gap for investors simply disappeared.
In the middle of 1994, investors, particularly American ones, started getting nervous and started telling the Mexicans, look, we're leaving. And the Mexicans said, wait, don't go away. You don't like our pesos? Fine. I'll transform your investment in pesos into dollars. And I'll pay you 12, 13, 15, 16, 17% on your dollar investment. This is a great deal. But the danger was, of course, Mexico didn't have the dollars to pay those investors back if they all wanted their money at some point. Well, it's pretty simple what happens. Collapse.
In December 1994, the Mexican government was running out of the dollars needed to pay off its mounting debt. If the peso collapsed, no one would get all his money out. Global investors panicked and began to flee. There was panic in Washington, too. One top official warned that the unraveling of Mexico's finances could lead to a true global catastrophe.
Why were they so upset in Washington? Well, essentially because there were all these American investors, both institutional and sort of mom and pop investors, who had money in these Mexican bonds, these $30 billion of dollar-denominated Mexican financial instruments, which were not going to be paid. This was, your pension fund. And all of a sudden, your life savings were on the brink of collapsing.